Hey folks, it's Simon here with your Tao Daily for Wednesday the 11th September 2024. The market's put in a couple of more bullish sessions. We had obviously a big down day on Friday, and then Monday the S&P was up 1%, and yesterday we're up just under 0.5%. And the NASDAQ has strung together a couple of bullish days as well. All right, so we had the big wipeout on Friday, down 2.7%. And then up 1.3% on Monday, and then up nearly 1% yesterday. So does that mean the worst is over? Well, not yet. You see, until we take out Friday's range, either break out to the upside or to the downside, these inside bars, so bars that are contained within Friday's price range, really don't tell us anything. Okay, so I'm really looking for a break to the upside of this high to kind of get more bullish, or a break to the downside to get more bearish. And honestly, I think the market is neutral to bearish at best at the moment. Price is below all of the key short-term moving averages. Momentum bars have turned red. You know, there's nothing that kind of gets me wildly bullish about this chart at the moment. We've got CPI today. CPI inflation. It's a lot less interesting to the market than it was a couple of years ago. All right, really looks as though, at least in the short term, inflation is no longer a concern. And what the market is going through at the moment is a growth scare. And what a growth scare is when there's clear signs of economic deceleration, and whether it's just a soft patch or whether that becomes a recession. So a growth scare can turn into a recession, and that's what we need to watch the data for. So things like employment data are far more interest to the market these days than CPI data. The CPI has become relatively more predictable than it was, and big surprises. We haven't seen a big surprise in CPI now for months. You can see the last two non-farm payrolls prints we had were that one there and that one there, both kind of big down days for the market. The last CPI print we had was August the 14th, just here, bit of a non-event for the market really. So if the market remains in a growth scare or let's call it a soft patch, the indices can still do okay. We could still look at a sideways to up kind of pattern in the S&P, but it'll be the sectors that have been leading more recently that will continue to lead. Okay, so things like consumer staples, utilities, financials quite possibly. Industrials have done pretty okay in that scenario, although I think industrials' relative performance will start to slip, and it'll be the more growthy sectors like tech and communications that will continue to underperform. So in a soft patch, those more defensive sectors, like healthcare as well, they can be a pretty good place to hang out. It's only if we go to a recession where kind of everything starts to fall, and in terms of equities, there's really nowhere to hide. So if we do go from a growth scare to a recession, I would expect all sectors will perform poorly in terms of absolute performance. Defensives will still probably perform better in a relative sense. But, while the market is happy to give the growth scare the benefit of the doubt, sectors like healthcare and utilities are a pretty good place to hang out, consumer staples. That's what I got for you today. I hope it helps, and I'll catch you tomorrow. Thank you.